Boy, oh boy, I've got to be careful what I ask for because the sellers have finally stepped up and in a big way. If you recall from the Monday stream, I specifically said, what I would say is, if the sellers are going to do something, then please, let's do something. Let's create a new downtrend. So with these new developments, let's take a look at what's going on in our markets. Quick reminder that a thumbs up on the video goes a long way to support the channel, and we'll get started here. So certainly on the Tuesday open, we get a gap down, and we've closed extremely weak at the lows of that day's trading range. On today's session Wednesday, we've definitively produced a lower high as well as a lower low on the bar-to-bar count. We've also closed ever so slightly underneath the low of Tuesday's session, so it's quite clear to say that yes, bears are in control of this price action. What's a little bit more meaningful, though, is what's taking place from a trend perspective. If we think about lows, higher lows, we had a line in the sand for our next set of higher lows at 403.75, and obviously all of the price action this week has been underneath that line in the sand. Therefore, the daily trend is changing to the downward direction clearly, right? So we had a prior low, now we have lower lows from a swing perspective. We've closed underneath all key supports. We had 405.75, 403.75, the line in the sand. Then there was an opportunity for more of like an equal low outcome here, closer to $400.75. We've clearly violated that in the downward direction as well. So it does strike me as being very bearish from a location perspective. If we take out our Fibonacci's from the low up to the high, we are clearly underneath the 38.2 Fib now, which was confluence of support with 403.75. And if I show you our anchored VWAPs from all of the 2022 dips, as well as the anchor here, the breakout candle, we are underneath this cluster of key anchored VWAPs. Recall also that the pink dashed line is the all-time high anchored VWAP. So that does strike me as being more of a bearish development, considering that there was confluence of support around the structural area closer to $400.75. You could make the slight, ever so slight bullish argument that we have found support at this anchored VWAP, but notice it does not coincide with structure for confluence. And I would say the same thing if we throw back on our 50 and 200 SMA. We did technically bounce off of the daily 50 SMA, but there is no confluence of a technical or structural level in this overall zone. So the bears are making significant progress in the downward direction. We've also closed here underneath the lower edge of the weekly expected move. So the question comes up, are we overextended on the daily time frame chart? I wouldn't really say that just yet. And the primary reason is that we're breaking out of a balance area. We're really breaking down from a balance area, right? So this is the balance. And whenever we break a balance, we typically look to double that range. That's, psychologically what we look for from a measured move perspective, which would suggest there's more room to fall closer to 390, 350. Now, whether or not we go there immediately on the Thursday, Friday session, that's besides the point, but what I'm getting at is there's still some room to fall from a measured move perspective and where the technical target would be from this particular setup. Now, how do we actually get involved in playing a downtrend? Really, there are two ways. We always want to be looking for the lower high entry in a downtrend or the equal low breakdown. And currently sitting on a lower low with a little bit of support at that daily 50 SMA, the anchored VWAP. Once again, it's not an end-all be-all support, but there is a bit of a lower wick here. I would say it might be wise to wait for some sort of lower high to be produced on the daily time frame chart. Now, where do we want to see that form? Line in the sand, really, underneath 405.75. We could afford to bounce up to that, produce a lower high underneath the bulk of the overhead balance here, break, retest, and then fall. That would be a great place to look for short entries if the market starts to show some signs of rejection. We could obviously reject off of 403.75, and if we just go sideways here for bear flag consolidation, I would advise you probably take a look at the hourly time frame chart, which we'll do in just a second. If the bulls are going to get any progress, meaningful progress in the upward direction, it's got to be a higher low back above 405.75 to reclaim really the bottom end of this balance here. And it's also got to get above the high, the gap fill reversal from the Tuesday session. So 405.75 higher low is what the bulls need to see at this point in time. Then maybe we could reconsider as a look below here, fail back into the range, so the sellers fail to keep it underneath, and then we would retarget the highs. I don't know that that is extremely likely, especially based on the internals information, which we're about to look at. But first, let's take a look at the hourly time frame chart and be a little bit more nuanced about the price action. So the sellers strike me as strong for a number of reasons. Again, the internals, a big reason, but from a structural perspective, we got the gap down and a gap fill reversal on the Tuesday session. So there was an attempt to rally from the buyers, correct the overnight inventory, and the sellers said, nope, we're not going to accept in Friday's range. And from there, the rest is history. We moved lower. So this structurally strikes me as important from the sellers. In the past, we know that sellers have been frustrated when gap downs have actually led to rallies and price acceptance in the prior day's range. That was not the case on today's session, a clear shift in tone. Now, on today's session, the Wednesday session, we saw a midday rally, but look at where we find a lower high right off of that $400.75 mark that we were just discussing on the daily time frame chart. Because of that nuance, I would say yes, sellers are paying attention and looking for those key zones to start new short positions. Now, we talked about the opportunity for a dead cat bounce and then repositioning for a short, not chasing the lower low down here, but on a lower high up against 405.75. How might that move start? Well, if you can start to think about this in advance, right? If this is going to turn into a double bottom on something like an hourly time frame chart, then breaking this neckline, maybe there's an opportunity for intraday scalps in the upward direction that get us to these backtest areas, 403.75, the gap fill reversal area, or 405.75, the key balance lows from right around in here. So if this is going to produce a lower high on the daily time frame chart, don't be surprised if the hourly needs to flip into an uptrend first just to get to these areas. And that key level to watch would be $400.75. If the market continues to consolidate sideways underneath $400.75, that's where you would look for the hourly bear flag setup and then the equal low breakdown to get us to that daily level, which we were just describing at 393.50, the range double from the sort of balance rules that we had been discussing. So that's how I'm thinking about the market as we move into the remainder of the week. Another thing that I would just point out from a higher time frame perspective, this is not pertinent to what we should do tomorrow, but may offer up a little bit of insight into some if we get choppy action in the market. Recall that the weekly trend is technically up with lows, and highs, higher highs. So it's completely reasonable that the weekly chart is searching for that higher low to confirm the next leg in this uptrend. If that's the case, of course, we would have to imagine that on the daily time frame chart, we fall into a small downtrend to get to this area where the weekly higher low could be produced. So because the weekly is competing with the daily at this point in time, I would not be definitively bearish saying that the market is going to zero here. Intraday and intra-week, absolutely, will have a bit more of a bearish edge. But when and if we get to 390, I think there's an opportunity for the weekly time frame chart to try to step up and find a higher low. So if the breakdown continues into the remainder of the week, when and if we get to 390, I would definitely put on your critical thinking cap and say, okay, is the weekly time frame chart trying to find a higher low, or do we just blast right through it? Remember, if this is going to turn into a weekly double top, it's really going to get nasty underneath 380. And sure, we can look for all the bearish outcomes in the world. If we take out 380, we're just simply not there yet from a weekly time frame perspective. Time for some supporting evidence. This is the market internals. If you're not familiar with this screen, top right-hand corner's got you covered with a brief tutorial. The main takeaway from this screen is really looking at today's session as digestion of the significant move that we saw on the Tuesday session. So from a volume perspective, significant outflows Tuesday, well underneath negative 300 million, and no improvements to the net read on the week from today's digestion day. So not significant from a rebound perspective, really more indicative of bearish consolidation. The same thing can be said about advanced decliners getting very bearish underneath trend negative zone on the Tuesday session, and we did not see a back-to-back read where everything all of a sudden became a buy. Remember that this is usually unsustainable to see reads this significant in either direction, and typically if you're just going to get market volatility and a lack of acceptance, just, wild swings and no real trend, what will happen is that this will correct, but it'll overcorrect and we'll see overcorrelation in the upward direction. On today's session, that certainly was not the case. We did get a correction of the overcorrelated state, but not to the degree where it's indicative of volatility back and forth. This to me strikes me as much more like, hey, maybe things got a little aggressive yesterday and we'll be above the zero line today, but nothing crazy, right? You can certainly make the argument that into the close, of course, this is much more neutral. So once again, this strikes me as bearish acceptance and digestion on the lows instead of a big rebound. The same thing is evidently clear here in the cumulative builds in the tick. Significant downside build on Tuesday. Of course, vastly different than everything that we saw throughout the course of last week, barring the Monday bullish build. And on today's session, again, digestion. It just kind of makes a very lackluster build in the upward direction and neutralizes by the time the close comes around. So overall, internals to me would support the idea that bears are making a stand here in a significant manner, and today's session was really bearish acceptance instead of some big reversal back for the upside direction. Let's take a look at the market profile. If you don't know what this screen is, top right-hand corner's got you covered with a brief tutorial. On the Tuesday session, value is definitively lower in the overall range, and the point of control also closing fairly weak. There's no disjoint with volume being produced up here and something wacky with the point of control. Overall, this speaks to bearish acceptance towards the lows of this newfound trading range. On today's session, we are getting value that's overlapping to down, once again confirming the bearish nature. And although the point of control is more centralized in today's session, isolated, right? It is technically underneath the Tuesday point of control, indicating some advancement from the sellers in the downward direction. In terms of excess at the highs and lows, I would say that we have decent excess at the highs and lows of today's session, as well as Monday. We have a string of single prints up here towards the highs. That's noteworthy because if we do get that hourly double bottom reversal intraday for a little bit of a move higher, you might want to be aware that we could find resistance prior to the Tuesday high of day, right? And that's going to be 40.43 in your ES. And if we move on over to the platform and have a look at the SPY, it's going to be right around 402.89, 402.90 in your SPY, okay? So if we do break this as an hourly or 30-minute whatever double bottom, you might run into some resistance before 403.75. That would be more bearish, right? If we roll over for a lower high here, it's indicative of a failure from the buyer to move price through thin structure. That, of course, once again, is a more bearish lower high than having to search all the way up here at 405.75. How about the weekly performance of our sectors? What we'll notice is that the XLP consumer staples leads the way by being down the least, down 0.12% on the week thus far. At the bottom of the barrel, we see real estate down a whopping 2.34%, primarily because of what's going on with rates right now. We'll take a look at the TNX in just a moment, but the heavier weight risk on sectors are really towards the midpoint of this lineup. Don't get me wrong, they are all still red on the week, but they're not getting completely obliterated, and they're also not getting out unscathed. The structural charts will continue to light the way. So XLP, consumer staples up first. Notice that this is continuing to go sideways in this balance area, finding a bit of an inverted hammer off the top of the range. Doesn't strike me that it's, going to start leading the market higher anytime soon, but it's also not threatening a break, at least as of right now, underneath 72, really more neutral for markets. XLB materials, really lightweight sector, but it is breaking down underneath the neckline of this head and shoulders. I would just watch for continued bearish outcomes underneath 80.75 and back to neutral if it's above. Next up, we have the energy sector threatening the bottom of its daily balance area, but because this is a more defensive sector, if it breaks down, it doesn't strike me as the end of the world if, here's the key component, if we see a rotation into tech, into financials, into consumer discretionary to sort of pick up the pace. Obviously, if everything's selling off, downward pressure is still downward pressure. If we get a bounce here, not the end of the world, it's not threatening leadership over 93.25. XLV strikes me as a cause for concern, noting the close here underneath 130.50. We talked about the bullish engulfer on Friday's session. It didn't produce any follow through back in the upward direction, noting that this is kind of what was keeping the markets sideways or slightly afloat. The breakdown of this level strikes me as significant, noting that we have thin structure off to the left. This is not a bullish development and certainly aligns more with the bear thesis. Continued price acceptance under 130.50 is bearish, getting back above really just more neutral, if anything. XLC also breaking down underneath this area of support. Backtesting a little bit on today's session, but from a trend perspective, right? Lower highs, lower lows, lower lows. So even if it bounces, it can find another lower high and continue its move in the downward direction for a weekly backtest of 52.17. Of course, intra-week, that is bearish pressure. Next up is the tech sector, the heaviest weighted sector of them all. It's do or die time, right? It's do or die at 135. This is where we need to see a weekly high or low above the prior congestion zone from here for something that gets back into the overhead balance. This, of course, has doubled its range already. If we do something like this, you'll note that we're basically at the target. So 135 is the key number to watch. If we remain above, it probably means neutral market. Of course, any lower highs that start to reject off of the overhead supply here off the bottom of that balance at 139.25. Look for short opportunities in your markets if that is the case. And then, of course, the equal low breakdown is playable if that's the case underneath 135, right? You're looking at this as a bit of an H pattern, lower high, rejecting the overhead supply. If we accept above 139.25, all right, it's game on. Maybe the bulls are going to make a final stand here. Next up, XLF financials breaking down underneath 36. Recall that this was the prior top here, top here, top here, low end of balance. Now that we're underneath, it looks concerning. We have a 3-bar play on the daily time frame chart with not a whole lot of structure underneath us until we revisit 34.50. Break down the 50 SMA and boom, the door is open. So flushing these lows is critical into the end of the week if sellers are going to continue the momentum in the downward direction. Bulls, of course, you got to recapture 36. Look below and fail. As of right now, with today's bearish acceptance at the lows, doesn't seem like a high probability outcome. Next up, we've got the XLY consumer discretionary. Breaking down from what you could call a double top. We are underneath the neckline, 3-bar play, except a green bar here as the resting bar. Looking for continuation, right? Looking to close this gap. We are getting price acceptance back in this overall range. It's not that great if you're a market bull. You wanted to see progress remain above 148. If we get back above, fine. Maybe there's some kind of inverted head and shoulders that plays out over time, but this structure right here on the bar-to-bar count does not look all that promising. Next up, we've got utilities, much more of a risk-off sector. It is moving lower with our markets. So again, neutral to sideways here is absolutely fine. We don't want it falling off of a cliff. If it's just moving in tandem with markets in the downward direction, that's fine. As long as it's not providing leadership or really starting to outperform up and over, I would just use 69 as the first key break point. As long as it's not doing that, doesn't strike me as a full-blown risk-off look just yet. We'll see that in the ratio grid as well in just a moment. XLI for industrials, no longer putting in that clean ascending triangle with a break of that roughly sketched in trend line, right? Really capturing these lows instead of this anomaly breakdown here. $100.50, that's the key number. We're still technically right on the zone. We're at the 50 SMA. I would give this one the benefit of the doubt, and because of the strength of this move, because of the distance and the time we've been consolidating, if we can just hold up here and play sideways, neutral and beneficial for the market. Remember that this is roughly 8% of the S&P 500. It's not going to save the day, but it will help from an all-out breakdown in our markets if $100.50 holds. Not quite convinced that it's just going to, flop and go here. If it does, just treat it as bearish pressure. Really monitoring this level on an individual basis. $100.50 there. Next up, XLRE real estate, as we said, really getting just absolutely pummeled based on rates. Big move lower here, but are we breaking down underneath that key zone we've been describing for the past, couple of months here, 37.25? Not really. It's much more of a lightweight sector. It's not having downward drag on the S&Ps, much more to do with the wealth effect and people's net worth kind of going in the south direction, which of course is not ideal from a discretionary spending perspective, and you can see how that kind of ripples through into affecting other sectors. So as a component of the S&P, it's not so meaningful just yet, but from a ripple effect perspective, certainly not great for markets here. Here is our ratio grid, top right-hand corner for a tutorial on how to set this up. Overall, the top 4 are the risk-on sectors, and I would just point out that they don't look all that bad, to be honest with you. It's not so much that risk-off is fading away into the oblivion, it's the fact that the bottom 4 down here, the risk-off sectors, are actually perking up ever so slightly on a relative basis and finding a bit of a floor. Don't get me wrong, we see a pullback here in the XLK, but in the context of an overall uptrend above an upward sloping 50 SMA. We're still holding on to this weekly double bottom in the XLV, although curling over ever so slightly on today's session. Financials, this is where there is a cause for concern. Of course, there was no break of the resistance trend line, and of course, failing underneath 36 on the daily time frame chart is a cause for concern. So this does not have me feeling warm and fuzzy, but notice that the XLY is really just going sideways in high and tight consolidation if you were to think of this as an overall bull flag. So it's not so much that risk on has deteriorated, but rather risk off is starting to perk up ever so slightly. One cause for concern would be to look at growth versus value. So XLY growth versus XLP value. Notice that we did break down underneath this key zone right here. So intra-week, it certainly could provide some downward pressure for our markets if it requires a weekly higher low. Remember that sort of competition we pointed out between weekly and daily time frame charts at this point. If we require a weekly higher low here, intra-week, it's definitely bearish pressure into Thursday and Friday's session. Recall that this area needs to hold because it was prior lows. Then we got a lower high, which was the nail in the coffin here for this brief down move into the end of 2022. Taking a look at our dollar, we'll note that we are still technically in a daily downtrend with lower highs possibly in play underneath 105. But if we zoom in on this, you'll notice that the bull flag breakout from this perspective is still alive and well. An anomaly here that I want to point out, or rather discrepancy between the dollar and gold, is that the dollar never actually took out the low of the inverted hammer, and it just kind of held the top of the breakout range here. If we compare that to the look of something like the GC contract for gold and zoom in, what we'll notice is that there actually was a break over the hammer high. So there was an opportunity for gold bulls to try to make something happen in the upward direction, but that move failed, which of course would mean the dollar has some room to move higher, which of course has some bearish implications for equities. That relationship is worth continuing to monitor. It seems that the market's very sensitive to the dollar at this point in time. The other thing that it's supremely sensitive to at this point is rates. And I want to bring up the signal study just to show you that, we've been sort of keeping an eye on this over the zero line and the rate of change for quite some time. The fact that we are now continuing to get price acceptance over the weekly double bottom neckline is a big cause for concern in equities. Remember that this puts an immense amount of pressure on the XLK tech sector, which is the heaviest weight risk on sector we have for the S&P 500. The more price acceptance and the more time we spend above 3.8 really in the 10-year, the more bearish it becomes for markets, and Jerome Powell has continued to reiterate higher for longer. At this point in time, because we have produced, think about trend, right, a higher high, we could still afford a higher low pullback in rates and then see continuation in the upward direction. So from a technical perspective, this is not a great looking chart if you're trying to remain a market bull. Having a look at the FOMC Fed tracker, so to speak, you'll continue to just note that the market is pricing in more of an impact from the rebound in inflation. The opportunity for a 25 basis point rate hike continues to diminish as the odds of a 50 basis point rate hike continue to improve. Recall that in the weekend update, we were still sitting at a north of 80% probability odds of a 25, and now we are underneath 80%. Once again, I would find it very unlikely that Jerome Powell flip-flops back to a 50 basis point rate hike, but PCE will be a massive concern on Friday at 8:30. Join us live on the channel. We'll be live at 8:15 to catch the market's reaction and kind of see what goes on from that perspective. We know it's scheduled to come in hotter than the prior month's reading, but the big tell here will be if Jerome Powell has to backpedal on his inflation stance, which, by the way, he's been very clear about saying, hey, the disinflation process has begun. That's been what the market's really anchoring to from his prior press conferences. If he has to backpedal on that stance and say, hey, maybe things aren't going as well as we thought, if he even mutters the word inflation is back, or words, I should say, inflation is coming back, just look out below, right? We'll just leave it at that. Look out below if Jerome Powell has to reevaluate his stance on the progress that's been made thus far. TLT bonds up next to gauge risk appetite in this market. And notice that although we are still underneath this balance area in the ratio, if we zoom in, you'll notice that there has been an outperformance from bonds over the past 5 or so trading days. This becomes concerning from a flight to safety type perspective, noting that the last time this happened, although we are extremely low in the ratio, when we saw this outperformance, if we just do something like this, there's a period of uncertainty in the market and it does resolve in the downward direction. Although it's not sustained for a long period of time, it speaks to the uncertainties of the risk appetite for the equities market at this point in time. And the same thing can be said about the HYG. The main threat of this chart is really a breakdown of this low at 72.75-ish as a zone. And the reason that's a threat is because if this is going to be called as a divergence, 3,800 would be the target in the S&P. Certainly bearish outcomes into the short-term and near-term outlook of the S&P 500. It hasn't broken down yet, so we're not calling for this, but that's the threat of this chart at this point in time. Of course, this divergence has already panned out, and we are seeing that breakdown in equities. It could get worse if we violate the low here from the HYG. Up next are the breadth indicators. New highs versus lows is back down at the 0 mark, which does not strike me as a bullish look by any stretch of the imagination. Remember that we want to morph into something that looks like this and avoid something that looks like this. Obviously, being at the 0 line threatens more of an opportunity for bearish outcomes as we move forward into the future. Not a great look to see this where it is currently. Next up, we have our stocks above their 200 SMA in the S&P 500. Not a great look breaking back down underneath this prior topping pattern from here, but not the end of the world, still being elevated above the 50% mark. What is a slight cause for concern is if we take a look at stocks above their 50 simple moving average in the S&P, Note the clear breakdown of the 50% mark in that actual calculation, right? So the more time that stocks are spending underneath their 50 SMA, the more opportunity there is for bearish things to take place in our market. A constructive look here would be a bounce that quickly, very quickly, like this and like this, recaptures the 50% mark. Getting continued price acceptance underneath 50 simple moving averages is not bullish by any stretch of the imagination for our market, so a slight deterioration here. The sweet spot, as we've pointed out, is really right here, above 0.6, kind of around 0.7, and not in contrarian zone up around 0.9. Next up, we've got the RSP equal weight, which is deteriorating as well. So what once was offering a very nice looking higher low above the prior breakout point, speaking to the underpinnings of the market being more bullish than bearish, no longer holding. We are clearly underneath that and much more in alignment with the breakdown that's taking place in the S&P itself. So this is not really reinforcing better than expected outcomes as we move forward. The same thing can be said about our Dow divergence, checking in on industrials versus transports. Industrials are no longer threatening the break over the top of this to confirm the move that we saw in the transports, and the transports at this point in time are also breaking back down underneath the prior area of resistance, which broke out and did offer up a higher low. It simply didn't hold. So this is sort of confirming, let's not get ahead of ourselves with the bullish nature of our markets. There's been some significant deteriorations out there in the underpinnings over the past 2 trading days, which hopefully we've pointed out in today's video so far. Volatility also isn't looking so hot for our markets. Recall what was once prior support was acting as pretty solid resistance in the early stages of 2023, but in the past 2 trading days, we have gotten price acceptance above that level, which of course is 2050. It speaks to the possibility of improved bearish odds into the future here. Let's have a look at the volatility of the volatility index, the VVIX, and although it's not flashing any warning signs up and over 120 or even spending time above 103, I would just point out that it is elevated in the overall range. It's sitting right on the upper edge of this balance range where it's been most comfortable for the past few trading months. So if it's going to become less of an issue for the markets, it wants to return to 75, perking up over 103, big warning sign for our S&P markets, noting the potential for a catastrophic outcome moving forward. It hasn't happened yet, but it is certainly staying elevated in this overall range. If we take a look at our volatility futures to determine whether or not we're in a contango, we certainly are. We're well underneath the 0 mark, but notice over the past few days, we've made a move in the upward direction. Speaking once again, as we saw with VIX and VVIX, the market's slightly uncomfortable with where we stand right now, but it's certainly not as bad as it was when we were in this segment of the market over here. If you recall, really after the summer ended in 2022, we were basically in backwardation at 100% of the time. We're not there yet, but once again, the market is becoming slightly more uncomfortable and uneasy about upside outcomes, and the opportunity for something catastrophic is slightly increased based on volatility. QQQ NASDAQ 100, very similar to our S&P 500, with all of the price action this week underneath our key pivot at 296.50. Does strike me as a bearish breakdown. You could think of this to this as a lower low, starting a new daily downtrend. The interesting thing about the QQQ, though, is if we do rally, there's an opportunity for a lower high, don't get me wrong, off of 302.75, but the bears need to make it back down for an equal low. The confusing part about this chart is if we do something that looks like this with a higher low back above 296.50, really the daily trend is not so clear, and I would classify it as more neutral as opposed to an outright downtrend. So a little bit different in that sense from our S&P 500. I would also note, very, very nuanced here, we did close inside of the Tuesday range instead of underneath like the S&P 500. We're still above a 200 SMA. We're still above and did not test a 50 SMA. Let's have a look at the IWM, what's going on with small caps here. Certainly almost the same comments as what we just said about the QQQ. We did close underneath this pivot here at 189, lower edge of the weekly expected move. We're getting price acceptance underneath it on today's session, but although this is a lower low, there's the opportunity for something that looks like this. It seems more reasonable that something like that could happen in the IWM and Qs as compared to the S&P, which has much more upside lift required to get above 405.75, right? So that's what's not so clear about the IWM and the QQQ, but please don't get me wrong. I'm not advocating that this is the primary outcome. It would become much more neutral on the daily time frame chart. I do think that this is bearish acceptance. All of the charts we've run through so far would be indicative of things shifting shifting in our market. Downside outcomes in the IWM will be catastrophic if we need to make that rotation all the way back down to 180-110. Obviously, that's quite a ways to fall, which would be bearish pressure and really a risk-off signal for our markets. If you've made it to this point in the video, you know the deal. Hit the thumbs up button, the subscribe button, the bell button, all that good stuff, and let's dive right into Apple. What do we see here? Certainly a very interesting chart, finding support at the daily 200 SMA, and also failing to close this gap all the way, closing back inside of the Tuesday range. I'm not pounding the table for bullish outcomes here, but I would keep an open mind to higher lows above 151, preserving the weekly bull flag, and then possibly looking for outperformance when and if, keyword if, buyers can get back above 156.50 inside of Apple. So today's daily structure really does strike me as fairly interesting. Again, open mind about bullish outcomes. Staying underneath 151, don't get me wrong, this is now overhead supply. We'll look to see if we can get the equal low breakdown. This is the next more meaningful range to trade for, down towards 142. Next up, we've got Netflix, which as well, let me leave it zoomed out so you can see the overall uptrend in place. It's been a massive outperformer through most of 2022 and into the early stages of 2023. Noting that we are in an uptrend, I would say that there's an opportunity here for a higher low to form somewhere around this gap, right? We've got the daily 50 SMA meeting us here for confluence of support. Maybe if we can get something similar to Apple with a daily hammer candle that forms, a partial gap fill, a failure from the sellers to close it all the way. It's a long back over the high to reattempt the bottom end of the overhead supply. That would be a not easy trade, easy to identify possibly the targets up there at 349.65. So really watching for a reversal here out of Netflix, noting the strength of the daily uptrend. If it breaks down and closes the gap, gets price acceptance underneath, different story. We'll reevaluate for a daily lower high. Next up, we've got Tesla. What's going on with this one? Fake break all over the place in this one, moving underneath 197.50 for an early morning flush, but closing back above and inside of this balance range here. I still would advocate for waiting and being patient for longs only when and if we break 213, the top of this flag, and truly negate the opportunity for a daily double top, right? If this is going to turn into a double top, let it turn into a double top, wait for the breakdown of 190, the lower low, and then we'll trade in the downward direction. As of right now, the hammer candle has me optimistic about longs over the top to revisit the top of the range. Think about this as a pressure cooker top, 213. You can only knock on that door so many times before someone ultimately opens up on the other side. Next up, we've got Google, definitely more bearish here. Although we did print a hammer candle, the breakdown of our daily bear flag range has begun ultimately, and we got price acceptance underneath. The next big breakdown is underneath 90.60 to get back down towards these lows. That would be a significant range to trade for. So if it takes a while to form out some consolidation and then flush, so be it, right? Let it happen. That range, when and if it opens up, that's what you want to be sort of looking to take advantage of. If we move in the upward direction, I would watch for lower highs to form underneath 95. Anything above 95, start to reconsider this chart, really more choppy than anything else. Next up is Meta, certainly threatening a downside move as well, with continued lower highs on the daily time frame chart. Big inverted hammer after the morning outperformance quickly turned into a collapse, closing inside of the Friday range, and now we have a little doji down here at the equal low. A breakdown clearly gets you to your next structural support at 161, but technically this is all open gap. The big support is at 153.65. So continuing to watch for downside in Meta here. Bulls really only content with a higher low over 180.20. Doesn't look likely as of right now. NVIDIA earnings after the close here, and they are currently trading 225.98 by 99. So where does that put us? Somewhere up in this area. So a bit of a fake break from today's session. Maybe that keeps the market afloat tomorrow. We'll reevaluate for the pre-market live stream, but so far we'll be opening on a gap up somewhere in here. I think you've probably got some trapped shorts if that's the case. If we can hold this gap up for tomorrow's session, of course we'll reevaluate, but if we can hold that gap up, you've probably got some trapped shorts who started to recognize the breakdown of the double top neckline here, who start to panic out on tomorrow's open. So gapping green over this area does strike me as being potentially squeeze-worthy for some upside outcomes. Again, take this analysis with a grain of salt. It really depends on where we open tomorrow morning in NVIDIA. Next up is Microsoft. What's going on with Softy? Continuing to get some price acceptance underneath this choppy range, so much more definitively bearish now that we've broken down underneath these lows here, much closer to 255. Watching for congestion. This one does strike me as being slightly extended just due to the gappy nature. Notice that we gapped down here, we gapped down here, we gapped down here. So gapping all over the place, starting to go sideways. watching for any excuses on a lower high and then equal low breakdown, or just consolidation, then an equal low breakdown, right? So Microsoft definitely seems to be more of a short setup. If it wants to confuse us all and do something like this, maybe we'll scalp it for this gap close overhead, but really being cautious of bullish outcomes in softy. Last but not least, before a couple of trade ideas, is the mini beast Amazon. Inverted hammer on the backtest of these prior lows. This is like a picture perfect setup. Breaking down underneath the low of today's session, opens the door here, 92.25, watching this setup like a hawk tomorrow, really, just based on the fact that we have daily head and shoulders pattern unfolding. We've got break, retest, and go type pattern unfolding, right? So as long as we remain underneath 96, watching the flush of today's low to open the door into 92.25 and monitoring for continuation. Delta Airlines, first trade idea for you. It's a 3-bar play setting up on the daily time frame chart, confluence of support at the 50 SMA. So flushing those two things at once, looking for a breakdown to close this prior gap into the target at 36. That's a day trade, but from there, notice that we have thin structure on the way higher. If you wanted to turn it into a swing and hold a portion of it, the big target would be down below at 32.30. Cheaper price stock, be prepared to buy multiple contracts or just keep your expectations in check and not look for a home run on this particular trade. Next up, we're going to look at HD, earnings candidate recently, and also setting up a 3-bar play with a gap to close underneath. So inverted hammer on today's session, rejecting the daily 200 SMA, equal lows, a breakdown there puts us at 292.50 to close the gap. And then this is not so clear, so monitor for continuation. I wouldn't take all of it off at the gap close. I would hold a piece and see if we can get the follow through, but the structure here isn't so clear. It's not thin. So if we do start to bounce, be prepared to stop out on Home Depot and don't be married to a big home run trade there either. Shop is up next. What's going on with Shopify? Indecisive doji after a breakdown of the prior low, closing inside the range, getting tangled up at the 50 SMA. I think that this, like Microsoft almost, has been beaten up on these gap downs and follow through. It's at a 100% retracement and some of this overall move. So if it's going to see a dead cat bounce, I could see playing into some of this thin overhead structure as a long on the breakout over possibly 42.86. Earnings are out of the way, so just something to keep on your radar if we need a long setup for tomorrow's session. Last but not least, we're going to take a look at Snowflake. SNOW is the ticker there. And the idea is a short on multiple inverted hammers back to back here, equal lows, 50 SMA. If all this stuff breaks down, intraday target for a scalp is 145.25. Plenty of range there to be trading for. 5 deltas underneath the 150 breakdown point. And if you do want to monitor for continuation, the bigger level would be 135. Not interested if it takes out the top of those inverted hammers. That's all I've got for you on today's session of the Midweek Market Update. Hope to see you live on the channel tomorrow morning at 8:30 and Friday at 8:15. I wish every single one of you a green trading day.